Welcome to AssetTV. We're at the mid-year point of 2021. Joining me to discuss the market cycle and the investment landscape is Adrian Helfert, Chief Investment Officer of Multi-Asset at Westwood. Adrian, welcome. Thanks for joining me today.
Thank you for having me.
Well, first and foremost, could you walk me through how you view the framework of the economy as well as the market cycle and help us understand where we are within that framework at this mid-year point?
Sure. It's a good question, and I think it behooves all investors to think, maybe not prospectively forward, you should think that, but that's harder to diagnose. But where you are in an investment cycle can help you think about how you deploy risk, where you deploy risk. And I think there's some similarities in all investment cycles that help you divine what that might be. Myself, I have my own framework. And to just think about the vicious and virtuous cycle at hand, to think about whether the cycle is coming to a stop or what things are driving, I think about a circular framework that starts with really consumption. Consumption is good. It drives capital expenditure. It drives companies to start buying machines to make more of those widgets that you're going to consume, those useless toys that I buy my kids, or the washing machine that I need. Subsequently, when corporations spend more capital expenditure, that means they hire people. They have to hire people to manage the machinery. They have to hire people to manage the people managing the machinery, which means more demand for jobs in the same supply. Just basic supply demand means you get higher wages. Higher wages means confidence builds. And when confidence builds, then of course, maybe I go buy a new red car, those new toys for my kids, the new washing machine. So you have this circular cycle that is confidence, that is consumption, that is capital expenditure, it's wages, and then of course it's jobs and it's wage inflation. That is one that also can turn vicious. So if we see a lack of consumption, you start to see corporations cutting back, wages coming down, jobs coming down, subsequently confidence coming off. So that's a cycle that I look at for saying where we are. Are things going to continue? For a specific longer term cycle, that is, what I look at as a credit cycle. That doesn't mean corporate credit. That means credit is an engine of the economy. When credit contracts, it can pull back on consumption. It can change the nature of the recovery or the expansion. When, of course, credit expands for the economy, more people are spending, you can pull forward on consumption, you can see economic expansion. So I think of credit as an engine of the economy. When I look at a credit cycle, I put it in 4 distinct phases. And for each of those phases, I can look and say how things perform. Kind of the first phase would be cash generation, where companies are building out on their margins. They're using those margins, of course, to generate cash for which they can pay their employees, which of course creates good wage inflation and confidence in the economy. Now, subsequently, they start looking forward and saying, gosh, we're seeing all this consumption, we're going to start spending, we're going to actually maybe borrow in the markets so we can buy more of that machinery. And once they do that, you kind of get down the speculation phase. You see leverage in corporations rise up. Oftentimes, you see leverage on consumer balance sheets rise as well, as they feel good. They'll go buy the fancy red car and they're going to finance it with credit. So you see those kind of metrics that are occurring in, once you go from cash generation over to a speculation portion of the cycle, markets are appreciating, but leverage is going up and balance sheet metrics are starting to deteriorate both in consumer space and in corporate space. Subsequently, you can start to hit deterioration. Deterioration is often when you see financial metrics start to come off or a financial easing closure. Maybe the Fed pulls the punch bowl and says, a lot of irrational exuberance out there. That could actually cause some concern for the environment. So when they pull the punch bowl, then subsequently banks hesitate to start lending or lend as much as they have before. You see financial conditions start to drop. In the worst case, of course, you see a housing market crisis and a Bear Stearns market blow up, or something that really causes a mass closure, which means you hit a default cycle for corporations, which means you see a retrenchment of credit. You see after that a balance sheet repair phase. And so now we've gone from what is a cash generation phase to a speculation phase to a deterioration phase. We're all the way back to balance sheet repair phase. Balance sheet repair really is where we see that usually pretty rapid closure. And then corporations start building their balance sheets again. You don't see much of the irrational exuberance because the memory is very fresh of maybe high unemployment rates or lack of confidence, and so it takes some time. Then you get back to cash generation. So I look at that, and the second question you asked, of course, where we are now. I do still see a virtuous cycle in place. I see that consumer confidence has done really well recently. We're seeing it now rebound considerably. People are confident. They're going out and saying, you know what, quits rates is really high. Even at an elevated unemployment rate, people are quitting their job, and you don't quit your job unless you're confident that you can get another job more often than not. Consumption has done well. It started with more non-discretionary consumption. They're replacing the washing machine, doing things on maybe your house, or things that aren't necessarily buying those useless toys for your kids or the fancy red car. Now, we're also seeing that discretionary come back as well. Travel and leisure is key to that. So there are areas where we're seeing that work. So that subsequently means that we see capital expenditure hopefully come back. We're seeing more of that, but it's been kind of in a over decade-long morass. And a slowdown of that since the global financial crisis, the GFC, has meant that corporations are sitting with the oldest age of machinery on their balance sheet in decades. So we will see a replacement cycle. We're not seeing that so much yet. We're seeing some of that come out in the Duke CFO survey I like to follow, that says CFOs are saying, maybe it's time to spend, as we're starting to see economic activity that we should want to take advantage of. Inventories are very low. Just-in-time processing maybe is not going to do it. They're going to have to build inventories. That means we see, of course, demand for jobs. We're going to see wage inflation. We've seen that already. So that cycle is in place. Subsequently, thinking about where we are in that four-piece sort of credit cycle, I think we have started to cross over into what is the speculation phase. We are cash generation. Things have been good. Margins are high. Margins have been high. And this is very, very rapid for a recovery that we've seen. I mean, this is when it first happened with the COVID crisis in March, April 2020. I spent a lot of time modeling jobs, for instance. How rapid can the unemployment rate recover from what was depressionary levels? No time in history can I get the recovery rate that we have seen so far. It's extraordinary what's happened. Now it's an extraordinary cycle for which this was more furlough than truly demand-driven unemployment. But at the same time, the recovery has been very rapid. You see this in various industries. So I think we've already come through much of that crisis. We've already come through much of the cycles that have been balance sheet repair. We're in cash generation. We're now in speculation. We'll see companies that are increasingly taking advantage to build capital expenditure and advantage of economics coming in the future.
Well, Adrian, I think you've given us a very thorough overview and a better understanding of your framework. So how concerned are you at this point about the COVID-19 Delta variant and its potential impact on the continued reopening of the U.S. as well as the global economy?
I am concerned, certainly. I don't see the negativity that we saw, of course, around March and April of last year, when just a full closure, and you could, of course, where I am in Dallas, all the roads were finally open and there was no traffic. That was the only nice bit about it. But at the same time, I do think certain segments of the population, those that have children that are 11 and below that haven't yet been vaccinated, are going to be more restrained in their activity if we see a spike in COVID Delta variant rates, which we are. That said, the populace is ready to emerge, ready to spend, and they're more trained now as well. They're more comfortable going out with mask on, including with their children, remaining distance. Companies have, think of Starbucks and others that have 6-foot distance measures in place. And so there are things that have changed since we went through that initial downturn. That said, what I think is interesting, it's not necessarily the Delta variant, it's the Lambda variant, the Gamma variant, it's all the other, it's the COVID 2023. I think we are in a place where, of course, seasonal flu is seasonal. It occurs every time. COVID is something with a higher mortality rate for a healthy population, so maybe something more concerning, which for markets means a risk premia. And we may see a higher risk premia, just as we see with the volatility index, which many people think of as the fear index now. It's run at an elevated level over averages since this happened, even as markets have appreciated and hit new highs. I think we're going to see more of that risk premia for not just the Delta variant, but going forward through seasonal periods until we really have a good vaccination rate coming forth.
And Adrian, within your equity allocation, do you have a current tilt toward growth or value?
I do. I have a tilt towards value at the moment. And I'll go back and define for a second and say the value orientation oftentimes picks up companies that have production of nearer term cash flows. These, think energy companies or things that actually, even it's a little bit different than the name implies. Value companies do well when the economy expands quickly. So think about energy and financials where more loan rates happen, demand for energy as there is stimulus in the environment. Last year, we saw growth outperform significantly. And that was in part, and growth is, think tech. Think these things that are, the Tesla cars flying around in Blade Runner 2054, when cash flows are realized much further into the future. I think that growth outperformed last year a little bit of a different reason than value has been outperforming the first half of this year, and we've seen a little bit of a normalization. Last year, of course, we saw a change in technology. We saw the possibility that people start using Teams and Zoom and these technologies that otherwise might have taken 3 to 5 years for us to really adopt. They probably saved themselves 3 Super Bowl commercials of having to get the adoption going just by COVID happening. Coming into 2021, we've now seen at the first half of the year, we did see the value tilt perform because financials started to emerge with the possibility of heightened economic growth that we've been talking about on the reemergence. So more lending, a steeper curve where net interest margins increase for them. The energy prices have been going up, oil prices have been going up, and copper has been going up. I'm still value tilt. And it increasingly is because I have a viewpoint that I think interest rates are going to rise. I still have some interest rate duration on. Yet if interest rates rise, what's going to happen to those cash flows that are produced for those companies, regardless of the revenue profile? Let's say that Tesla, that cars flying around in 2054 that are floating around with Harrison Ford flying through the air, those cash flows realized in the future, the expectation of those hasn't changed, but they get discounted at a different rate in that DCF model. If interest rates go up, they get discounted higher, cash flows go down, valuations go down. That means growthier companies underperform when interest rates go up. So right now I have an outlook that I think interest rates will rise from where they are now, or really the interest rate curve will rise from where they are right now, so where it is right now. That means 10-year interest rates will go up, and that discounting rate will mean value companies, things that are producing cash flows in the near term, will outperform those of growthier companies. So even within my equity allocation, which is different from saying how am I going to stylistically apply my risk within that equity allocation, my equity allocation, I have a long orientation, but I have pulled back on risk as valuations have realized much of the economic activity that we are now expecting. But within that, I'm stylistically looking for value to outperform.
And Adrian, as someone who invests across multiple asset classes, how do you view the current relative valuations, and how are you taking advantage of that in your flagship strategy, which is Income Opportunity?
Yes, thank you. We look at multiple asset classes, and let's say those, for instance, are equities and bonds and commodities and all subsets in between, or not just asset classes, but style variations. You think momentum or growth or value within that. Those are certainly things that they're all belonging in the, even if you have a negative outcome, I think on investment grade bonds, rarely are you saying it's disadvantageous to have some of those. Right now I am looking at the risk-free rate government bonds as extraordinarily unattractive. Usually you hold government bonds or you hold rates for 2 key reasons. You hold it for the income, which today government bonds are running between 1.2 and 1.3% on a US 10-year. That seems extraordinarily skinny to me. And it is based on history. And you run it for the insurance policy. You hold it for the insurance policy, so when equity markets drop, then subsequently your bond markets rise and they help offset some of the losses that you experience in a blended format on your equity side. Right now, we are seeing that insurance policy is still in place. We've seen economic activity expectations come off in the last couple of weeks from extraordinary high levels, from an expectation maybe of a 7% real GDP growth rate, which is extraordinary, to down to around 6.5% consensus now. But you did actually see rates reflect some of that come off, some of that pullback in the equity market. So there is some symmetry, some of the insurance policy in place. The income component is reasonably skinny. I think you can find that elsewhere better. That's real estate investment trust. That is looking at several places in the energy sector that are more near-term cash flow production and dividending that out back to their equity holders. As we are in a more comfortable place now, if not absolute highs on financial conditions, that gives companies a better indication of being able to pay out those cash flows for investors. So for myself with multiple asset classes, while I do hold some interest rate duration for the portfolio, I am looking for more income increasingly in other asset classes that are cash flow generation oriented, that are putting out that income elsewhere. Corporate bonds I think of as separate to interest rates. And oftentimes I think people aggregate those things where I can have a targeted interest rate exposure. When I mean interest rate exposure, I mean government bonds, risk-free rates, versus that excess income that I get for owning even a Microsoft 2-year bond or a Microsoft 10-year bond. That compensates you for the possibility that they might default in 2 years or 10 years. So we do look to expressly invest in companies that we feel provide us with a very good compensation versus their default probability. That's just another area that when we separate it out, and any good multi-asset investor, I think, separates it out, then we're able to find excess income. And if you separate that out, you say, I really do not like having, a 1.2 to 1.3% U.S. Treasury right now. Just seems skinny. But I can earn excess income by owning the right corporate bonds and evaluating them well on a fundamental basis. And then, of course, looking elsewhere into asset classes that are cash flow generation for income.
And Adrian, you brought up inflation earlier, and we know that there's been a lot of focus on inflation recently. So what is your assessment of the Federal Reserve's Balancing Act, and considering that they're sustaining economic growth as well as increasing concerns of an inflationary backdrop? What do we have to pay attention to?
Sure. Inflation as a big topic in the market would be an understatement. And the Fed's Balancing Act, there is no balancing act. I mean, if there's a seesaw, they're sitting on that one end with the kid up in the air on the other end. It's inflation kind of kicking its legs out. They have expressly said they're not worried about that right now. They are considering it transitory until they absolutely see the whites of the eyes of structural, however you want to state it. They're going to let the economy run hot. We'll see more information on this, of course, at the end of August with the Jackson Hole presentations. But as it stands now, the Fed has said, nothing to see here, don't worry. Focus on jobs, focus on unemployment, focus on that portion of the economy. And when at the beginning we talked about a circular cycle, that it's a virtuous cycle, I think the Fed thinks similarly on that. And I've put a lot of time into that framework to think inflation is not a metric in there, but jobs and wages are. That's what the Fed is looking at. Now, of course, there's another thing that, and we saw this at the last Fed meeting, that transitory inflation, if the Fed says it's transitory, they can make it transitory. And I think that's lost on the market quite a bit, where there's an argument as to whether it's transitory or structural inflation. There's a possibility that we hit a high inflationary environment or a runaway inflation environment. But if we hit high inflation that is concerning, say 4%, then transitory becomes transitory because the Fed will act at some point. That's why I still am a believer in it's transitory inflation. There are enough deflationary forces, plus the Fed will act at some point to ensure we don't experience runaway inflation. It's hard to fight that beast, and investors don't usually win by doing that.
Well, I think that's a very jarring analogy and a good way to look at what's happening right now. But based on what you just mentioned, how does that affect your view of opportunities within the asset classes that you invest in going forward, and in particular with the fixed income market?
Sure. Even though all I say about the Fed producing transitory inflation and thinking it's transitory until proven otherwise, I do think investors should put that on its head a little bit. The risk premium for a high inflationary environment is significant, as is with a deflationary environment. I don't think we're there. I think we are extraordinary amounts of liquidity in the environment, extraordinary amounts of stimulus from the central bank and fiscal authorities, or the Treasury, that the risk is weighted on the seesaw to the side of the possibility of heightened inflation that I don't know about they can't control. That's a step too far for me, but it's going to concern investors, or at a minimum, it will make its way into commodity prices, into emerging markets. into energy prices, and more so than investors think. We see this already. We see this with housing. Anybody that owns a house that's listening in is, I'm sure, happy recently and probably just hitting the refresh button on Zillow just to see when it's gone up. You see it in football cards. My goodness, I mean, anything that is a distinct asset is extraordinary. And the stories around the football cards now, like the rookie Tom Brady card going for $500,000. My goodness, those are distinct assets that are reflective of hard asset inflation protection. I do think it behooves investors, even though I say the Fed is transitory until proven otherwise, investors may want to think about structural until proven transitory to have some inflation protection on, because right now that inflation protection is cheap and the upside is enormous, or the downside is enormous to your portfolio if you're positioned wrong and we see higher inflation.
Well, Adrian, as you mentioned, it's amazing to see some of those double-digit or even triple-digit percentage gains with some of those hard assets that you mentioned. But I'm sure we'll look back at this time in history and remember those times. Now, Adrian, last but not least, before I let you go, can you describe how you view building a sustainable investment process that is geared to work across each phase of the market cycle? And also, you previously described this, but how does Westwood's Income Opportunity Strategy, how has it benefited from this approach?
Sure. Sustainable to me means, and I talk about with our investors about this frequently, consistent and repeatable. I always think an investment process should be consistent and repeatable. That does not mean that you can't navigate markets. It doesn't mean that you can't evolve the process, the consistent and repeatable component, but always try to look at things the same way so you can look back and go, why did that not work? Should I make a shift in my mentality or psychology or the process that we're using? But consistent and repeatable, let's have discussion points that work. And our income opportunity strategy, as with all of our strategies, are now using a process that we have expressly designed with that in mind, that is consistent and repeatable, and it uses the subjective and the objective. The subjective means these are the opinions of you and I as humans that have, with all of our neurons firing, thinking, hopefully we can see things that the computers cannot. Because these days as an investor, some days you feel like you're fighting computers and not the humans. So we use our subjective approach to look and say, how might politics affect the world? The fiscal stimulus bill is politics. What are the probabilities that we would place on that? How are valuations expressly considered? How is default compensation in corporate bonds within equity valuations? What do we think is going to be in the next bill that might benefit or not benefit from the fiscal stimulus? While the objective says our investment process should also look at data and say, especially when you're multi-asset, but even if you're multi-sector or even multi-strategy of any sort, you should say, how do I blend these things together with our subjective oversight to say these are the ways that we think about the world and produce the best portfolio? It is usually not simply saying, I think the best thing it's going to be producing is the energy sector. Thus, I'm going to have all my chips, all my eggs in the basket of just energy sector. Now, of course, that sounds dumb because you know that the aspect of decorrelation in a portfolio gives you upside returns by modern portfolio theory. We use that. Long story short, we employ a 5-part process in the income opportunity strategy. That is, we start with blending the objective and the subjective to say, how do we think the world might move? There's some macro look at this. That doesn't mean top down. That means we are going to blend top down and bottom up. So how might the world move? What asset classes are rich, cheap, based on historical measures, based on compensation, based on valuations? And we use a bottom-up measure of valuation that says we have a multitude of analysts that are looking and doing their DCF analysis and saying how much upside individual companies have. We can aggregate that and say, on aggregate, is that going up or down? If it's going up, then there's more equity participation maybe we should employ. Now, we blend that together in a way that says, this is a best implementation of a fund. Next thing is, of course, of our process is having a repeatable and consistent process to then evaluate how are we capturing that in stocks, in equities, in real estate investment trust, in master limited partnerships. We want to evaluate those things canonically in a similar format to say, is the valuation something rational? Is it good? Is it poor? How does it reflect historical valuations? And are there other things that we want to look at that are more appreciation capable. So we have a process that stimulates that. On fixed income, corporate bonds, I talk a lot about corporate bonds, pricing out it's not the rate component. I don't look at yields as that main component. I think of yields separately, and then I look at the compensation that I'm going to get for the possibility that this bond defaults or restructures or gets called. I'm going to use that and say how much excess compensation should I receive, or spread in our parlance. We have a format that we use that says this is the best implementation. We already have an idea of broadly how much are we going to have here, how much are we going to have in this asset class, and then finally rates. We look at tactically allocating interest rate exposure or that income and insurance policy to make sure we have an appropriate portfolio build.
Well, Adrian, thank you so much for joining me today, and thank you for all of your insights.
Thank you for having me.
And thank you for joining us. That was Adrian Helfert, Chief Investment Officer of Multi-Asset at Westwood. I'm Remy Blair from the AssetTV studios in New York City.